In 2025, we saw the financialization of digital assets accelerate sharply. What had long been viewed as a speculative corner of the market moved firmly into the institutional and regulatory mainstream. This past year brought major breakthroughs, from progress on the Genius Act in the US to growing regulatory momentum across the EU, the UK, and Brazil, along with continued expansion in ETFs, custody solutions, and real-world asset tokenization. So where does that leave the digital asset space today, and more importantly, what comes next? To look back at what defined 2025 and explore the developments likely to shape 2026, I'm joined by StoneX's CEO of Digital Assets, Brian Mulcahy. Welcome, Brian, and thank you so much for joining us.
Thanks very much for having me.
So let's start with this. Many consider 2025 a turning point for digital assets. What do you think really drove the financialization of the space last year?
Well, I think there's a number of factors. First and foremost, the asset class itself has sort of become impossible to ignore. We surpassed 3 trillion in total asset value within that asset class, and the volatility makeup of the asset continued to decrease. Over time, it has continued to decrease over time. So while there's still some volatility in the asset class to actually trade around and invest in, the fear factor of uncertainty has sort of continued to dampen throughout the year. The second major point, I think, is regulatory process and progress. This is an asset class that has sort of been under constant review for the last 6 or 7 years as it became much more mainstream. And what we've seen now is, through regulatory progress and through just development cycles, major institutional service providers, namely banks, custodians, broker-dealers, and exchanges, have taken up the mantle of sort of arguing for more sound and integrated regulatory framework around the world. Examples of that are the passage and implementation of the MiCA licensing through ESMA, the European Securities Markets Association, and that's really bringing 450 million consumers, and I don't have the number of institutions, under a single regulatory framework. It's highly prescriptive. It's a multi-thousand-page document, and it's a very challenging process to get, to complete provider. We know that because licensed in December of this year. But what it gives us is a very solid footing, upon which to build a business, which is, quite frankly, why StoneX Digital select a jurisdiction inside the European Union as its first, formal foothold into a regulated entity. So when you have multi-year dev cycles in very large institutions starting to be deployed, when you have some regulatory certainty throughout the Eurozone, the indication of regulatory certainty in the US, the indication of reg certainty in Canada, certainty in Japan and Singapore, pending, expectation of certainty in Korea. You start looking at the major jurisdictions around the world where sort of financial investment occurs, and you start to feel a little more comfortable, sort of sinking dev dollars and investment dollars into the asset class. So those become a bit of a self-fulfilling prophecy. And then finally, it was really, I would say, the release of the futures 2018 or 19 on the CME, and then ultimately the inflows into ETFs over this past, really in 2025, has been a major turning point. There's been 155 different ETP or ETF filings for crypto native, token-based ETFs. IBIT is BlackRock's best ever ETF launch. There 25 billion in inflows just in 2025, just into that one ETF. So I think you look at the adoption there, and it allows for people to trade these things in their existing structures and their existing prime brokers, and they can engage with sort of a DTC based, settlement. And you're seeing more and more inflow. I mean, the last stat I would give you is, I think it was an Ernst& Young survey, that something like 86% of institutional investors replied saying that by 2020 would have some exposure to the asset. So institutional adoption is here for sure.
That's right. I mean, I would agree with you. Regulation, actually, to me, was one of the biggest themes of 2025. You already mentioned MiCA going fully live in Europe, but we also had the Genius Act for stablecoins and the Property Digital Assets Act in the UK. So, I guess, why is all of this regulatory movement so important for the market's next stage?
Well, I mean, this is the first asset class that sort of developed before regulation entirely and really worked from retail up. So that's one interesting factor, and I think it can't be ignored when we look at the sort of, the dev path, adoption path, and regulatory path, and why they're sort of out of sync with people's normal cadence. I think also if you think about building a business in any product, even outside of financial services, or building a house, or building, you know, anything that you're looking to create, sort of needs a stable foundation. And regulatory certainty is that stable foundation. We look at some of the frauds that took place before we had primary market jurisdictions who were regulating these activities. That's not to say that we don't see fraud and other issues in the sort of old school TradFi regulated world, but they become much more pronounced and sort of much more just in the early stages, as saw an opportunity to enrich themselves. I think if you're accepting funds, whether you're an asset or a hedge fund or other sort of pooled investor, you are you have a fiduciary and other many responsibilities to your investors to protect that capital. And people get obviously people pull investments that aren't performing quite well, but an investment that disappears is a whole different story, right? So the protection around people's assets, even in the institutes, is critical. I think you also have regulatory bodies, saying to the world's largest financial institutions, aka the banks and major brokers and non-bank financial services firms, if you touch it, we'll take your other business away, right? If the SEC actions, all the no action, all these sort of SEC enforcement actions that took place, for 3 or 4 years, were, were sort of existential threats to larger institutions who really can't run afoul of the SEC or FINRA or the CFTC. And so they've had to, tailor or cater their adoption to regulatory, to jurisdictions that would allow it. Again, that's why we launched, over 2 years ago, our effort to get this MiCA license so that we could start a business as a VASP, a virtual asset service provider, and become a CASP under ESMA. Our clients are asking for our audited financials, for our publicly, available disclosure documents, and all the things that come with this sort of regulated framework. I don't tend to deal in the retail space, but clearly regulators are generally more concerned with, with mom and pop, and making sure that if you deliver assets into something, that what you're getting. So that's where a lot of the push for similar rules to securities regulations on issuance are taking place in UK and the US, all throughout Europe. Anyone who's sort of involved in the issuance, the creation of these investment contracts, what information needs to be put out there, right? Is it a full prospectus? Is it less than that? So all these things are happening. You did mention, obviously, in the background, there's been significant work around the more, I'll call it not the boring side, but the less publicized components around what is this asset? What happens in a bankruptcy? Is it an asset? Is it an investment? What are the bankruptcy rights? What are the termination rights on contracts? How do we integrate this into ISDA so that you can, have swaps on these and post them up to, a consolidated tape and an SDR. There's obviously a lot of putting a consolidated tape for OTC contracts in this up. I know that's a conversation throughout Europe today, so that there is similar, look and feel to all other products that we trade. So with that, you can have institutions lean in, and then when you bring in the sort of existing frameworks of ETFs and futures and standard TradFi basis trades and funding and financing, you start to see, the snowball.
Yeah. Well, last year we actually saw a huge jump in institutional participation. So would you say that institutions are officially in the digital space now, or is this still an early phase?
I would say 100%. Well, not 100%, but again, going back to that study, which I believe is EY, it was like 86% of institutional investors, were saying they had or will have exposure, sort of by 2026. So even call that into 2026, it's a pretty big number. I think that was probably a curated list of who they surveyed. A lot of different. There's a lot of different studies out there, but certainly the number of hedge funds who report being involved in this space is up again from 2024, although I think a lot of the funds were in there a little earlier than, quote, traditional sort of long only investors, stock pickers, so to speak. But I think there's some sort of anecdotal evidence as well. One of the largest financial services conferences in the world is the crypto conference that takes place in October in Singapore with something like 25, 30,000 people. You look at the Futures Industry Association conferences, the Securities Industry Association conferences, even the global alts and iConnections down in Miami and over in Singapore. They had 3 meeting rooms in iConnections Singapore, and one whole room was dedicated to digital asset companies. If you look at the investment from private equity firms into the space, there has been a lot of try and fail through 21, 22, 23, building products and then finding the solutions they were made for. I think now with a solid regulatory foundation and sort of more institutional investment, grade determinations, we're seeing more and more products now launched that are actually out to solve a problem, and they've been custom built to solve that problem. So all these things just give people various different ways to invest in this space. We're going to coin a new term here that I actually heard from a client of ours over in Singapore.
All right, but take credit for it, Brian.
Well, we've had equity capital markets and debt capital markets for a long time, but if you speak to our experts over at Benchmark today, we're really starting to see a new breed of sort of token capital markets, TCM, and it's this sort of integration of the technology with the ability to move assets on chain, and or focusing on these new service providers and their funding and financing needs. So it's sort of like a Venn diagram of equity capital markets and debt capital markets to help these predominantly technology focused, service focused firms to build out the capital stack they need to support their business. It's really no different than sort of pre-IPO, servicing of the listed market.
Mm-hmm. Then would you consider asset tokenization the next major growth driver then?
Yes and no. I think there's 2 components to this. Well, there's a million components to this asset class, but I think you can sort of split the focus into 2 paths. So one path is it's a new technology, and there are a number of different different reasons to adopt the use of distributed ledger, sort of DLT, blockchain technology, the ability to validate transactions and move assets and settle assets in a better way. We're not there. The technology is there for sort of like atomic settlement, as it's called, right? The instantaneous, trade and settle at the same time and same message. The tech is there conceptually, and it can be done in small doses, but it's not there to sort of replace or be supported by DTC or FICC or Euroclear just yet, right? I mean, that's going to take some time. We just got to sort of T1 in the U.S., right? And um, so there is a lot of infrastructure that I think will change over. But I don't think most consumers or investors are particularly interested in the infrastructure side, right? That doesn't really necessarily grow the asset class. It just essentially over time should make the processing, trading, and settlement of these different assets smoother. And with smoother and more immediate should be less cost, right? So I think there's a whole infrastructure, design that sort of bleeds into the business side, and I think I think that should start to separate a little bit, where you'll have, your office of the COO, so to speak, who's working on transitioning your settlements in XYZ product, off of the traditional, fix and Swift and onto sort of, Lightning and other sort of, DLT technology settlements, right? More efficient, quicker, more automated, integrating some AI into that to sort of make sure you're checking for any reconciliations, and you can be doing much faster settlements with, frankly, probably less people, um, and you have access to your cash more quickly, so you don't have dead capital that's just sitting in settlement cycles. So that's a whole infrastructure play. But then there's the structural change that I do think will allow for growth. And so an infrastructure play to be able to communicate differently is one thing. But working with firms like Securitize, who is out there preparing to actually become a transfer agent and issue new securities, new equities, but issue them on chain as a transfer agent. Now you have a transformative change in the way people are actually doing business. You're changing the front office tools they're using, changing their processes. That's that sort of in between. Is that a business driver? No, but it's a massive change. Now you are impacting sort of the front office and the end client, right? And how they actually interact. So I think we I think tokenization of sort of standard real world assets will allow for some better financing, some better settlements. But I don't know that that substantially drives new revenues. Um, I think if you look at stablecoin, though, that is really where you will see a massive changeover in both revenues and flows.
Right. So that was my next question. Where do you think we'll see the most meaningful developments in 2026?
I think the integration. I think 2026 is all about um, the major players entering the space. So I think it's an acceleration of 2025. We'll see what we should see in this quarter. The Senate, the U.S. Senate put forth the latest, or actually hopefully putting up to vote, the digital asset regulations for the U.S. Canada passed their version of the Clarity Act, sorry, of the Genius Act. Um, I'm blanking on the name of it. So we're seeing the adoption of stablecoin processing now for all of North America. You've seen the work of 2 or 3 years of regulatory bodies sort of come to fruition. So that's one. It's the regulatory next step in more primary jurisdictions, and not just the publication, but beginning to to adopt them and actually build businesses around them. I think you're going to see major players entering the space. We're seeing our competitors, scrambling to get a toehold. We were lucky to be a little bit early on the regulatory side, although obviously easier as more and more entrants come in. But that I think is quite helpful. And so you see a number of banks who are entering the space, or are doing more and more in the space. Bank of New York just put out their tokenized deposits press release earlier this week. We're in it as well. JP Morgan's, been sort of leading the charge on these 24-hour bank accounts and the ability to sort of tokenize assets that are held and used as collateral. Standard Chartered Bank has a trading desk in London and a substantial investment in not only their own MiCA licenses, but also their subsidiary Zodia. You're seeing, so you're seeing sort of bank adoption in the US and in Europe. Obviously, Credit Agricole, Deutsche Bank have each announced their intentions to support this asset class. Out there. So I think you're going to see regulatory clarity continuing to take shape. Going to see, banks and other major financial institutions continuing to either, innovate and or substantially, grow their presence in the space. And then you'll see the changeover from settlement, via cash to settlement via stablecoin substantially accelerate. I think it was Coinbase the other day that put out a stat that said there was, in their research, 33 trillion in stablecoin transactions occurred in 2025. Supply grew 50% in 2025 over 2024 from 200 billion to 300 billion. And I think it was Stan Chart that predicted by the end of 2028 an expectation of 2 trillion, and maybe by the end of the decade, because of the acceleration, upwards of 2.5 trillion in stablecoin and or sort of tokenized money market fund, which is essentially a yield-bearing stablecoin, in growth. So that's a 10x growth in 6 years. And that's not that kind of goes back to something I was saying earlier. That's not building a product and then finding a problem to solve. This is actually specifically in support of settlement, money movement, keeping finance sort of moving 24/7. And I think the acceleration there is by freeing up a substantial amount of sort of locked funds that are sort of sitting in places that institutional investors can't use them over and over again. I think that in and of itself is going to be a massive economic driver.
Okay. Brian, thank you so much for joining us. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.